Good day, grade 10s. You are required to complete 10.21 for week 2. I will be discussing the task with you as well as doing the corrections for the week. For week 3, you are required to complete task 10.22 as well as 10.23. Remember that we do have a WhatsApp platform. If you do come across any misconceptions, any transaction that you are not sure of, you can please WhatsApp me on the WhatsApp group. So let's get started. We are going to do rough retailers, trading stock, and consumable stores. The pre-adjustment trial balance figures on the 28th of February 20.8. They give us our balance for trading stock. They give us the balance for sales, cost of sales, and consumable stores. Adjustments and additional information. No entries were made for stock sold on credit, 1,320 Rand. The markup on cost is 50%. Very important is the markup on cost. Very, very important. Alright, remember when a business purchases goods, it is known as cost of sales. When a business sells goods, it is known as sales. And you are all familiar with the formulas that we use in order to complete or in order to calculate those figures. So again, I will give it to you. In order to work out your cost price equals your selling price times 100 over 100 plus your markup percentage that they give you. In order to work out your selling price equals the cost price times 100 plus your markup percentage given over 100. Alright, then they say at number 2, a credit customer. While a customer returned damaged goods, he was originally charged 390 Rand for these goods. A credit note for 330 was issued to him. The markup is 50%. No entries had been made. Stock costing 2,130 was bought on credit. On the 28th of Feb 20.8, this was not recorded in the books. After taking the above into account, a trading stock surplus of 1,500 was detected as per stock taking on the 28th of Feb 20.8. Stock taking on the 28th of Feb 20.8 revealed that 3,980 worth of consumable stores was used. So I just want to draw your attention. We have sold goods. And remember, when we sell goods, we have to update our trading stock account. And your trading stock account needs to be updated with how much it costed the business. So what are you going to update the trading stock account with? Your cost price. So yes, the sales has been given to you, the sales amount. But what am I interested in when I'm updating my trading stock account? I'm interested in the cost of sales amount. How much it was worth to the business. Moving along to adjustment number 5. Remember that when we have consumable stores and we do not use that consumable stores, it then becomes an asset. And the new account is introduced as consumable stores on hand. What have you got to complete, grade 10s? You have to prepare the trading stock account in the general ledger. And you have to calculate the post-adjustment figures for the following: trading stock, consumable stores on hand, sales, cost of sales, and consumable stores. You have to name 2 possible causes of trading stock surplus. and you have to give me what effect would a trading stock surplus have on owner's equity. And then refer to adjustment 2. Above, the selling price of stock sold was $390, but a credit note for $330 had been issued. List one possible reason for this. Okay, let's get going. So here we have our answers. A trading stock account, remember it's an asset, so it will increase on the debit side and it will decrease on your credit side. Did we have a balance brought down from the previous month? Yes, we did. The balance brought down, as you can see over here, was 46,660 Rand. Again, that is just telling me that's how much stock I have in my business. All right. Now we are going to record the adjustments and update our stock account. So remember, stock sold on credit. Remember what is happening in your stock when you sell your stock? It is leaving the business with the customer. So your assets are decreasing. Am I interested in the selling price? No, I am not. I am interested in what that amount of stock sold was worth to my business. They have given me the markup. Okay, so obviously you now need to go and calculate your cost price. Cost price equals selling price. What was my selling price? It was 1,320. And I'm going to multiply it by 100 over 150. Where did I get the 50 from? I literally took that 50% and I added it into the value. 100 plus 50 gave me 150. So let's go and do the calculation. One 320 times 100 divided by 150. Our cost of sales for that sale that happened is 880. And remember, stock was sold, so assets are decreasing, stock has left the business. Your details will be cost of sales. Which journal would it have been taken from? Your DJY, because we sold goods on credit. And can you see that it was worth 880 Rand? Moving along to our next transaction. A customer returned damaged goods. He was originally charged 390 Rand for these goods. A credit note for 330 was issued to him. The markup is 50%, and again no entries were made. So you are going to now go and work out the cost price. How much did we sell it for? We sold it for 390 Rand. And again, the markup was 50, so it's over 150. 390 times 100 divided by 150. The cost price of the goods that were returned is 260 Rand. Now remember, the goods were returned to the business. Returned. What is happening to your trading stock account? The customer is literally bringing the goods back to the business, which means trading stock is increasing. And we worked it out to be 260 as stated. So again, trading stock increases. On your debit side, your details will be cost of sales. Which journal would we have taken it from? My DAJ, the debtors allowances journal. Stock costing 2,130 was bought on credit. So remember, when a business purchases trading stock, that is the original cost price. And we bought it on credit, which means we have gained a creditor. All right. When we purchase trading stock, we bring that stock right back to our business. What is happening to our trading stock account? Our trading stock is increasing on the debit side by 2,130. We purchased it on credit, so our details will be creditors control. Which journal would we have taken it from? The CJ, and there we have the cost price of the trading stock that we purchased. All right. Then we move on. After taking the above into account, a trading stock surplus of 1,500 was detected as per stock taking on the 28th of Feb 20.8. So when you identify a surplus, it means you had more trading stock than what you calculated at the beginning. So obviously that will increase your trading stock account on the debit side. Your details will be trading stock surplus. Which journal would you have taken it from? Your GJ, and we have the 1,500 Rand. What you're going to do now, grade 10s, you're going to balance your trading stock account. You will add everything up. Which side is the bigger side? Your debit side. 46,660 plus 260 plus 2,130 plus 1,500 will give us a total of 50,550. Take it over to your credit side. 50,550, and you are going to subtract the smaller amount worth 880, and it will give you the difference, which is known as your balance carried down. We're carrying the balance right down to the next month, and this is just to say that we have a positive stock balance worth 49,670 after we have taken into account our adjustments. Moving along, we are now going to the post-adjustment trial balance. Post meaning I have taken the adjustments into account. All right, our trading stock, after taking all those adjustments that we have taken into account at the top, we have figured that we have a debit balance of 49,670. Moving along to your adjustment number 5, the stock taking revealed that 3,980 worth of consumable stores was used. That's the actual expense. What was not used? I'm going to find the difference. 4,440 subtract what was used will give me what I have left on hand. And that should be 460. Remember, consumable stores on hand is an asset, and that is why it falls under the balance sheet section. Your nominal account section is all about your incomes and your expenses of the business. Now, remember, grade 10s, we had an opening balance. Our sales was worth 90,000 in the beginning of the year, and yes, there were transactions that were not recorded. Example, the 1,320 was not recorded. As you can see, no entries were made. So you need to go and make the adjustment by showing me the calculation. This is what I had in the beginning of the year, and there was no record of the credit sale that took place. So I'm adding that sale to the sale amount, which will give me sales worth 91,320 on my credit side. Why is it on the credit side? Because owner's equity increases on the credit side. It is an income to the business. Moving along, cost of sales. Our cost of sales balance was 58,000 Rand. Again, we have to take into account the cost price that was not entered. Remember, no entries were made. And we worked out this cost price to be 880. Remember, grade 10. And again, the next adjustment was also not recorded. And I need to have the cost of sales amount, which was the 260. Again, this is not recorded. We need to record it in our adjustments over here. So there's our 58,000, our balance. I'm subtracting the 260. Why am I subtracting this 260? Essentially, I never made that sale, so it was brought back. I have to subtract it. All right. and I'm adding the 880. Why am I adding that 880? Because I made that credit sale, but it was not recorded. What is my cost of sales worth now? 58,620 Rand. Consumable stores, it's an expense. I want the expense amount. All right, I'm going to subtract what I did not use, because that unused consumable stores is an asset. I have to take it out of my expense account. So 4,440 subtract 460 will give me the actual expense amount of 3,980. Now remember, grade 10s, what do I do with expenses? I debit my expenses. And that is how you will complete your post-adjustment trial balance. Remember your calculations. Why should I remember calculations? Because they add for part marks. Do we want to miss out on any single mark? No, we don't. We have to capitalize where we can. Alright, so now we are going to answer the additional questions that they asked us. Name 2 possible causes of a trading stock surplus. There could have been an error in the calculation of cost of sales, or we could have received more goods than what we actually recorded in the account, or goods sold but the customer forgot to take them. So those are examples of things that could have resulted in a trading stock surplus. What would affect a trading stock surplus have on owner's equity? Remember, a surplus is an income to the business, and owner's equity will increase on your credit side. All right. Refer to adjustment number 2. So refer to adjustment number 2. The selling price of stock sold was 390, but a credit note for 330 had been issued to him. List one possible reason for this. The selling price of the goods has been decreased and the customer does not have the original invoice, or the debtor has taken very long to return the goods, so we are not prepared to refund him the full amount. All right, moving along to week 3's work, grade 10s. The other adjustments that can affect or arise within a year. We have bad debts. Bad debts is an expense amount. How do we get bad debts? Our debtors who we sell to on credit unfortunately stops paying us or does not pay us. We have to write that off as a bad debt. Bad debts to the business is an expense. What is happening to our debtors? We're losing them. And remember, debtors control is an asset, and assets decrease on your credit side. So the entry, bad debts, expenses will be debited. Debtors control, the asset is decreasing, which is why we are crediting it. Moving along to bad debts recovered. Remember, the bad debts recovered will be an income to the business. Okay, this is when a debtor who we had previously written off as a bad debtor comes back to our store or to our business and pays our money that was owed to us. All right. So it actually gives us the cash. What is happening to bank? Bank will increase on the debit side and we will credit the income, and the income account is known as bad debts recovered. Moving along, insolvencies. An insolvency is when a person is insolvent, they aren't able to pay off their debts or their liabilities. So we have an estate that will pay part of the debt to us, and the rest must be written off as a bad debt. All right, so a debtor who owed 500 was declared insolvent. His estate paid a dividend of 20 cents in the rand. The balance of his account must be written off. So grade 10s, we will have 4 things that must take place. The estate paid out is money, so bank will increase. Assets are increasing, they're giving us the actual cash. And remember, when our debtors pay us money, our assets will decrease. We're losing them as a debtor. Debtors control will decrease. The third transaction, we have to write off the rest of the money as a bad debt. Write it off. Remember, bad debts is an expense, which is why I'm going to debit expenses and I'm going to credit debtors control because I lost him as a debtor. Debtors control has decreased. Then we have interest on overdue debtors. Remember, interest on overdue debtors is almost like we are punishing them for not paying us on time. We are charging them interest. Remember, when we charge them more money or interest, they now owe us more. So debtors control will increase. Our debtors are increasing with us. Assets increase on the debit side. And then interest on overdue account is an income to the business. What do I do with incomes? We credit incomes. Then we have interest on our overdue creditors. Remember, creditors is when the business purchases goods on credit, it is a liability to us. And if our creditors charge us more money, our creditors control account will increase on the creditor side because now we have to pay them more. What is going to be the debit account? Obviously, the expense. It's an interest expense to us, so we debit interest expenses. Stock losses due to fire. Obsolescence. What is obsolescence, grade 10s? It's when a product is obsolete. It is outdated. Will people buy or purchase outdated products? No, they will not. And we can also lose stock through theft, etc. What happens when we lose stock? Our trading stock will decrease, so we will credit trading stock and we will debit the loss due to whatever the case may be. They will always let you know. All right. And then you will see that with this adjustment, they said stock costing was lost due to theft. A claim was lodged with the insurance company who agreed to pay $750. This amount has not yet been received. If the amount has not yet been received and it's supposed to be an income that should be for your actual current financial year, it then becomes income receivable. Income receivable is an asset to the business which we will debit. What am I going to be crediting? Loss due to theft. All right. The bank charges or interest on overdraft. You will always debit bank charges or interest on overdraft because that is an expense and we always debit expenses, grade 10s. What am I going to be crediting? My bank, because bank is decreasing. I am losing out on money. Stop orders / debit orders is an agreement that you make with your accounts. So if you have an insurance account, a DSTV account, Wi-Fi, Netflix, what happens? They will debit your account on a monthly basis. You are not actually taking the money from your account and making that payment. It's an automatic payment. So without a doubt, it will go off. What happens when this happens? We debit the expense account and we will credit our bank because bank will decrease. Money is leaving. Remember dishonored checks. Dishonored checks is when you have to refer to the drawer, the person who drew the check out for you. A dishonored check cannot be cashed due to following reasons. Insufficient funds. The signature is not on the check. It's an old check, meaning stale check. How long does a check stay valid for? 6 months. If it's over 6 months, unfortunately it becomes dishonored. Also, what makes it dishonored is the numbers in writing is different to the number in the actual number figure. All right, so those are reasons for possible dishonored checks. What happens with dishonored checks? We have to, let's read the adjustment. The bank returns a debtor's check for $365 due to insufficient funds. Then they gave us a discount had previously been allowed. Now remember, when we have a dishonored check and we've given a discount, the discount allowed automatically gets cancelled. What happens? The debtors control will now increase, because essentially we thought that the debtor has paid us, so we would have decreased debtors control. It's an asset, but because this check has bounced, that debtor never paid our money. So debtors control will once again be reversed and increase on the debit side. What happens to our bank? It will be credited. And then debtors control of 35 Rand will increase, because we have now cancelled the discount that we allowed that person. And discount allowed will then be credited. Drawings. The drawings account is always debited. You always know what to do with drawings. Dead click, right? And what will be credited? Let's read. For example, if the owner took petty cash for his own use, the petty cash amount is reduced. If he took stock for his own use, trading stock will decrease. So instead of writing drawings, you will then write trading stock, whatever he took for sorry, let's just look at the accounting equation. He's taken trading stock. Trading stock is going to decrease on the credit side, and then you are going to say on the debit side the drawings. So with that knowledge, grade 10s, I will need you to please complete activity 22 and 23. Remember, again, if you're having trouble with completing the activities, please send me a WhatsApp message.